The two components of return. The two components of return are yield and capital gains. Yield includes interest payments on fixed income investments, dividends from stocks, or distributions that an investor receives. Capital gains or appreciation represent the change in the market price of an asset. Total return is the actual rate of return of an investment or a pool of investments over a given evaluation period. It includes interest, capital gains, dividends, and distributions realized over a period of time. The dividend. Dividend income is money that shareholders receive as a portion of a company's profits. Dividends are ways for companies to share their profits with shareholders or ultimately the owners of the corporation. They're usually paid quarterly but can also be paid monthly or annually. The way that works is the board of directors decides the amount of a dividend based on the company's earnings. Shareholders can receive dividends in cash or additional shares. Cash dividends have tax consequences and they cause the company's share price to drop. Stock dividends are usually not taxed, but they dilute the share price. Companies that are more stable and established are more likely to pay dividends, while companies that are still growing may choose to reinvest their earnings. The dividend yield is the amount of the dividend paid per share expressed as a percentage of the company's share price. While it can be said that a good dividend per share is typically around 2 to 6% of the stock price. Now, both yield and capital gains or losses must be considered to determine the total return. For instance, an investor could have a year where their portfolio, worth $100,000, yielded $6,000 in dividends, but ended the year with an overall current market share price of $92,000. The capital loss would be greater than the dividend yield, resulting in a fairly disappointing period.